Okay, Larry McDonald here with the Hot Mic series. Thanks for joining us. I've got a special guest here today, Washington veteran, old-time friend, David Metzner. We've been through multiple years, over a decade in battle on the Hill, and it's great to be with David. I think one of the most important things in the market right now is Washington policy is driving risk assets more than pretty much anything else. So if you're a technical analyst, or if you're a fundamental analyst, equity analyst, credit analyst, Forex rates, the dollar, it really is all being driven by what's happening in Washington. So if you're not looking at things from a mosaic research perspective, including talking to someone like David, then you're really kind of behind a little bit, behind the curve. And David and I have been working together for more than a decade. And I remember the old days in Washington, being able to, not just Washington, but more so in New York, taking David around the street, meeting 5 or 6 hedge funds a day, the value that ACG Analytics and David Metzner have added to our clients in New York City and around the world has just been fantastic over the last decade. I want to thank you, David, for that, and welcome to the Hot Mic series.
Thank you, Larry. It's great to be back together again. I'm here in Washington, D.C. Probably most people join us today want to know, why does this guy have a tie on? It's how old-fashioned. And I want to assure you, I haven't had a tie on in months, but I am making a rare trip to the White House, and decorum is still decorum this afternoon. So, I felt very old-fashioned as I left my house this morning. But this illustrates one of the things we're able to do here in Washington is that we have an ability to actually still, even during COVID times, actually go and see people and meet with people. And traditionally it is, we have kind of a formal meeting, and part of our success is based on actually being able to give them insight. Okay, what is the street saying? Who's fighting with you? Who's supporting you? Other times, I go to reception, found myself where I was working on GSEs. I'm sitting across at reception from then Chief of Staff Mick Mulvaney. And I said, Mick, I have to ask you a couple of questions. And we stepped up to the bar, and he said, Mick, a lot of my competitors are saying there's noise in the White House about the GSEs. And he says, David, that's ridiculous. We're talking about impeachment and Russia. We're not talking about the GSEs. And again, this is the difference between New York and our ability to get color in Washington. And it goes across asset classes. I mean, we have a great team that works rates in central banks. We have the EM team that conducts fly-ins where we go to the IMF, over to the treasury to get their view. We do with think tanks live, sovereign calls here. Of course, the IMF meetings are amazing moments to look, for investors to look sovereign risk right in the eye and talk to bankers. Everyone is here. So it's, you have to be here. And we know how to add value to the conversation here in Washington. That allows us to participate and provide the insights that are so key in mosaic research.
Well, after working at 3 large banks over the last 30 years, is one thing I can take away for sure from all that experience is they absolutely do try to wing it from New York. They just don't spend enough time in Washington. And what happens is when you have an event like last year with the first fiscal bill, and then this year with this present bill, the street can they really can get caught off guard. They'll literally for 2-3 weeks they'll be talking down the reflation trade, then they'll catch up with the politics, and then they'll all jump back on it a month later. And meanwhile, the reflation trade's up 20%. So that's one of the big problems with the analyst community in New York. Take us through this weekend and the reconciliation process. It's a $1.9 trillion piece of legislation. And Larry Summers had a good point, and I don't always agree with Larry, but he's made some great points, especially the last 6 months. His point is, like, if you don't have true sustainable infrastructure spending in here, and it's a lot of transfer payments, the GDP boost won't be as sustainable as enough. So, and then you'll need a second bill and the time between the first bill and the second bill. Walk us through the first bill, where it is now, and this whole process.
Well, the first bill was altered, was altered in the Senate. The House, and so the Senate adopted bill now goes back to the House. They'll vote on it in the next day, and then that goes back to the Senate. They'll vote on it again.
The House try to put amendments into it, and then send it back to the Senate.
No, it's done. The bill is done, but the process of putting the bill together, in my opinion, really made it much more difficult to use reconciliation in the future. Reconciliation can be done twice a year. It's never been done twice a year, only once a year in the past. And of course, I think everyone knows it's such a Washington buzzword, but reconciliation is a budget process that allows the Senate to pass the bill with just 50 votes instead of the
50 votes.
Instead of the usual 60. Okay, that is called regular order that a bill needs. Now, obviously, to get 60 votes, they would need 10 Republicans to join them. And the Biden White House has made the same mistake that the Trump White House did. And that is, Trump started off, and the first effort was to repeal Obamacare and the signature assignment of his predecessor. That led, it was unsuccessful, if you remember the John McCain vote, but it led to a tremendous amount of divisiveness. Instead of reaching across the aisle and bipartisanly passing something, therefore to get your 100 days of bipartisan work. So the same thing happened here. We had moderate senators, including Susan Collins of Maine, go down to the White House. They proposed a $500 billion a bill on top of the 800 that passed in early January. Instead of offering her, they ignored it. Okay, and the bill was, every Republican on both sides of the Congress opposed the spending bill. This, in my opinion, will likely very much poison the water and make it much, much more difficult to pass infrastructure. Now, Senator Manchin of West Virginia got several things. He insisted against minimum wage, and he got the size of the income of the families dropped who could get assistance in this bill, and then he voted for it. He's already stated that he will not support infrastructure through reconciliation, and both he has said, which I think is common wisdom, infrastructure is by definition a bipartisan concept. We're all for better roads and bridges, right? Better schools, more 5G, and all that kind of stuff. So you should be able to come up with a bipartisan approach to this.
He wants some tax hikes, though. So Manchin, the centrist now, obviously there's two groups. I mean, obviously on the left, there's a big opening up to MMT. In other words, Federal Reserve financing the deficit. But in the center right, especially the Joe Manchins of the world, they're not big MMT fans. They want tax revenue. And so he wants a tax hike. Could they go after corporations? I noticed, you got to understand here in the markets, David, the NASDAQ's underperforming the Dow and the transports by like 10% over the last, couple of weeks. And you're seeing a really historic, colossal divergence between big tech and say value stocks. And that's pricing in a higher reflationary, higher inflation, maybe higher regulation for the tech stocks. But what can they do in terms of raising revenue? Could they create a special tax hike for large corporations? I mean, what are the options?
No, I think you look at clearly reversing some of the Trump corporate tax cuts is on the table in a negotiation. I think similarly, most of the big tech companies that have avoided paying taxes, that's something they could possibly consider. But you're absolutely right, Larry. Finding revenue is the key to a bipartisan infrastructure bill.
I didn't get.
And doing it and blowing up the Trump tax bill is not the way to do it. So they're going to have to find at the edges. Can they find $3 trillion? Probably not. Okay, so how much can they find and where do they find it? That's going to be a real challenge. But there is no reason, and I want to leave people here to think about this. There's no reason to think that a infrastructure today reconciliation bill of $3 trillion could pass the Congress, maybe the House, but not the Senate. And the key would be to find revenue, and that would be a challenge.
So what we do, David and I, we will sit down with hedge funds, mutual funds, pension funds around the world. And for people watching us right now, I really recommend a follow-up call on infrastructure. I mean, sitting down with the ACG team is really the way to operate. So
we have a great macro team who's tracking. We're on these bills. Our head of research, John East, is probably the only person who's actually lived through 5 reconciliation bills, knows the arcane rules back and forth. Helps shepherd those bills through as a member of the Senate Banking Committee. And then, of course, under macro, we're looking, obviously U.S. European trade, China trade are mammoth issues going forward.
Yeah, so anybody that wants to reach out and want to get on our distribution list, it's Tatiana at thebeartrapsreport.com. David, one thing I remember very, very clearly from the Trump experience, and I sense this experience, whereas when an administration comes in, the reflation gets priced in because everybody expects a bill. And then in this case, we have a recovery bill. But then if you have a big delay here between the next budget year isn't until the fourth quarter. So in other words, if you can't pass reconciliation with 60 votes through a traditional tax hike, and that could get messy, that could take a long time, at least through the summer, then your backup plan is go back to reconciliation in November and say, but that would be late in the year by the time you get the second reconciliation bill passed. And that's your real infrastructure. And as Larry Summers likes to say, that's your sustainable, that gives you the kind of throttle velocity to get out of recession.
Well, what it is, it's your seed corn. You're right. You said it really beautifully, and I think Larry said it as well, is that, if you use up the bandwidth of the U.S. balance sheet on transfer payments, you may not have the bandwidth for infrastructure. And infrastructure is the seed corn of the economy, right? It raises productivity, right? It further grows GDP, not just the consumption side of the equation. So I agree. I mean, couldn't agree more with him. I don't believe there is the political will at the moment to burden future generations with the size of the U.S. debt repayment that they're going to have to face.
And then there's the problem is, I remember you and I were in a meeting right maybe 6 months after Trump was elected. You and I were in a meeting in New York, a conference room, and the clients really thought their infrastructure was coming right away, because the street convinced the clients in 2016, 17 that infrastructure was like a slam dunk. I mean, literally sell-side research report after report. And you made a point around boots on the ground or shovels in the ground. In other words, you can get this, even if you get it approved, you need to have these projects approved, right? What do you call them, shovel-ready projects?
Yeah, I mean, this is the lesson. I mean, we know that it's, it's interesting. There's a difference between Republican and Democratic view of what infrastructure is. To most of us, it's bridges, tunnels, roads. And we know that, the environmental impact statement and the engineering, it's a 2-year process before you can probably put shovel in the ground. Then your economic cycle has moved on. So that's one challenge. The Democrats tend to look at infrastructure these days as, how do you green the economy, right? And they're looking at green technologies. They're looking at 5G for rules, for schools. So they're looking at schools, 5G, hospitals, not big dirt in the traditional, infrastructure sense.
And in that regard, in terms of the timing, so we could have a little bit of a delay, but let's think about the midterms. 2010, the Obama-Biden team, Chuck Schumer, Nancy Pelosi, they really got hit over the head with a 2x4 in terms of the Republicans took 63 House seats in 2010. Then by 2011, the Republicans started working in the sequester, and the entire recovery was kind of taken off path. Then in 2014, the Republicans pick up 9 more Senate seats, and then it was just massive amount of kind of austerity and control. And that created for people watching us right now, people think like that bond bull market that we had, you had Tea parties, you had Brexit's, trade wars, and then obviously COVID. So you had like 8 years of one thing after another containing the spending. If you're the Democrats and you live through that, they really have a vested interest to get some more spending done because they don't want to lose those midterms.
Well, let's talk about the midterms in a minute, but the Democrats have taken what they consider to be the defining lesson of the period. And that is that they feel that the Senate Democrats prevented Obama from going big on his Recovery Act. I think it was $800 billion. And they are determined, now that they're back in the White House, not to let the Senate Republicans do that to them again. That's how we ended up at a $1.9 trillion number without a really deep analysis, as to as Larry Summers pointed out, whether it's the right policy prescription at the right time. But they're determined not to repeat the same lesson. There's a belief that the Labor Department came out with 6.3% unemployment. They want to say the structural unemployment is more towards 10, but I think there's 200,000 more hospitality workers working this month than last month. Obviously, that's a big part of the story. So that's why they're pedals to the metal. They whether it's the right lesson or the wrong lesson from those Obama years and those Republican-controlled Congresses, I don't know. I don't think it's as important as it's their lesson, and that is that they want to go big, and they think that's essential. I am, if we want, we can talk about midterms. We got to remember that the political cycle is so short. I mean, once we hit November of 2021, we're a year out from the midterm elections. And I think, Larry, some of the commentary you've made lately is very interesting. I think this is going to be an election that really focuses on, I think the cost of petroleum will drive a lot of people's feeling. Okay, we all got very used to filling up our car for $2 a gallon of gas, and at what was it at sub $50 a barrel. And right now we have a lot. There's a drive in the Biden administration to green the economy, decarbonize it, to use their own words. And so we have that we have that trend layered on top of, that fracking, the restructuring of the fracking industry has scared a lot of investors away, even with rising prices. Will money come back into fracking, make up for the missing demand? And if the answer is no, because, investors have been burned enough, okay, what will be the shortfall and what will be the price of gas around the midterm elections? Last week, both the Russians and the Saudis said they're not going to increase supply. They want to enjoy the rise in prices. And you talked, Larry, about how Brent's gone from $55 a barrel and hit 70 today. I tweeted, a week or two ago, I said, look, if it costs $250 to fill up your F-150, we know which way the wave's going to crash at the midterms. All right. And that's the main, I think that's something we have to watch as investors. I mean, we're going to have, commodity prices. You talked about the value plays, commodity prices. We've consumed so much tech during COVID times. We're going to go out and people are going to travel. People are going to live. People are going to, demand. GDP is going to go up roughly. That people expect 6%, but it's going to go up 6% in China too, and that's a lot of hydrocarbons. So where is that going to come from, and how much is it going to cost? Is it going to be inflationary, and what is the impact on the midterm elections? That's what I'll be watching for.
Well, this is an example. The last time you were on our show was right before the election. You were pounding the table on a very close Senate. You were leaning toward Biden, and you said the House, Democrats, Republicans could surprise, and you pretty much got it right. But what that did for me is that gave me the confidence. our team at the Bear Traps report to really push into energy, because if you have a more centrist cabinet, more centrist House and Senate, then the more progressive Green New Deal would be devastating for U.S. energy. But so far, it's been a lot of executive orders. It hasn't been too extreme. I'm sure it can get more uncomfortable. But because that House and Senate, and especially in the Senate, were so tight, there's a number of things that have gone on. But I think the Saudis are looking at this, and the problem is U.S. production is down 3 to 4 million barrels a day. Worst case, maybe anywhere between 2 to 4, depending on obviously the situation in Texas distorted the data. But we're definitely down a couple million to maybe 3 million barrels a day in terms of production. The Saudis know this, but they could have really hiked production last week, and they didn't. And now, if you're the Saudi prince, MBS, he has much more control over the price of oil than he had a year ago, because the U.S. was going from 8 million barrels a day to 10 to 12 to 14. We were going up like a rocket. Now he can instead of increasing production, he can lay back and he can push the price higher. And he really has a lot more political control, because people aren't thinking about this. But MBS, literally, if he plays games with the price of oil, it can definitely have an impact on the midterm. So it's a very dangerous game that people are playing.
Look, we're running a foreign policy. They sanctioned not MBS, but a lot of Saudis last week. They have a huge payroll of princes. They got pensions and lifestyles. They need the money, and the real question is, if I'm predicting Biden said he's not against eliminating fracking on federal land or eliminating fracking. That's great, but watch the new head of the Environmental Protection Agency. What does he do in terms of regulations on water quality around fracking, setbacks? We saw in the state of Colorado that state law basically killed fracking in the state. So I think you're going to see a lot more regulatory pressure on fracking out of EPA. I think that the ban on permits on federal land that was supposed to be temporary will become permanent. There is more, the last quarter of 2020, there was a huge amount of permits put out by the Trump administration. So there's a little bit of a runway in that space, but it all ends up to what they have spoken about, which is a decarbonized approach to the economy. And there's only one way. There's only one result if you're gonna try to create a green future and decarbonize, and that's going to be higher prices. And that's a fact, and it's going to come at a very unfortunate time in the economy when demand is skyrocketing and there's a lot of cash in circulation. I'm with you and Larry Summers that we might have the first inflation in a generation. I think investors need to call their grandparents and ask them, what was it like investing in inflation? Because most people have forgotten. It's going to be a challenge. Different assets.
Well, one thing that you are so good at over the years, and I really have, it's been an inspiration to me, because you and I will always sit down in January, and then I watch you deploy your resources. And you're very good at kind of like listening to clients and figuring out, okay, where do I need to deploy research resources for the next year? I'll never forget in 2000, I think it was 17, early in 17, you were really out there in front deploying resources into Puerto Rico. And then a year later, we had a problem. And then same thing in Greece. And so you had great resources in Europe. But as we look at 2021, 22, where are you deploying resources? I personally, I'm getting a lot of incoming feedback from clients. Clients are very interested in nuclear power, because I think some of the things that Bill Gates have done and some of the movement on the Hill there. So I'm kind of like, we're deploying some resources in that regard, because I think that could be a secular bull market in nuclear energy, uranium. But where do you want to deploy capital in terms of what are you hearing from clients in terms of interest?
Well, I mean, it depends on the space. I mean, obviously, we are very close in the EM space, comparing, FX in Mexico versus Brazil. Okay, where are you in the COVID cycle? We publish a COVID heat map every week where we compare one country's COVID rate against a benchmark of others. This week we've done it roughly 32 times, 32 weeks. I think we did Morocco today. We think Brazil FX.
So ACG Analytics heat map.
Yeah.
ACG Analytics heat map, is that what you call it?
Yeah, COVID heat map comes
Okay.
out every Monday. We think Brazil FX is a more interesting story for a variety of reasons than Mexico. We think AMLO as president of Mexico, socialist instincts are there. He's struggling on, we think, we're working to figure out, is Pemex the Department of Petroleum, or is it a separate company with lots of debt? As we go to, same thing, interesting, the lira is getting crushed in Turkey today. We've been very negative on Erdogan. We think that the US and Europe will put pressure on all of the perceived friends of Donald Trump, but particularly on Erdogan. Similarly, we just completed the third note on Russia, very highly acclaimed piece of work. Russia is not a leveraged economy, higher oil prices, sort of some challenges demographically, but we've got a great EM team. And if you trade in EM, you should come and talk to us. Domestically, you've heard our view on petroleum. We're also looking at for-profit education, okay, a perpetual boogeyman of the Democrats. A lot of the pressure.
There's some stocks in the for-profit education, for-profit prisons, those groups.
Those groups are right. The for-profit prisons, much more. It's great to want to get rid of them, but you still have to put people somewhere. Okay. So, it's harder said than done. We're still working and researching that. So those are some of the early themes that we're working on. And of course, we maintain a very strong European relations. And of course, every Wednesday we publish our macro note, led by our lead analyst, Chris Zerwinski. And, that last week was a deep dive on trade. We've been telling people, and we were right, expect a rapprochement with Europe. But the Trump approach to China, the China policy is bipartisan. The Trump approach is here to stay. The Democrats are looking for a change. They're looking for a unique approach to China that's different than the Trump approach. Before, we had a bipartisan approach. It was called hug the bear, hug them more, they'll be more like us. That didn't work. Then we had the Trump trade wars, and according to the Sunday Washington Post, fascinating article about Chinese deceit during the COVID crisis. And now we have a bipartisan negativity towards China, and that's not going to change. So that we cover that every Wednesday, and other macro themes every Tuesday.
Okay. Well, this slide here is the perfect timing, because one of the things that we've been talking to clients about over the last, especially the last year, is, first of all, Maersk is the largest shipper on the planet, a great global indicator for really health of the economy, global economy. And that's a inverted stock chart. So as the yellow line goes down, Maersk stock is higher. And as you can see there, you've got a much weaker, you've got a much stronger Chinese yuan, so CNH. So as CNH has strengthened this year, it's given Germany, it's given Asia, emerging markets, an incredible tailwind when you have a stronger currency in China. As we saw in 2018 and during the trade war, when CNH is weakening dramatically, that puts a lot of pressure on global trade, a lot of pressure on other EM countries. And so there's a real multiplier effect, a global economic multiplier effect of a Chinese currency that's strengthening versus weakening. And as you can see here, over the last couple of weeks, there's been a little bit of flight to quality into the United States. The perception a couple of months ago was that China was coming out of this first, and the NEM was coming out first, and the US second. Now the vaccine's got such an impact with the fiscal deal combined. So you've got a positive vaccine channel in the United States in terms of the amount of vaccines, which are 2 or 3 standard deviations in the United States higher than France, for example. And then you have a $1.9 trillion fiscal plan that's putting higher yields up. So your rate differentials between U.S. treasuries and the rest of the world is now sucking capital back into dollars. It's weakening the Chinese yuan, it's weakening the euro. And so now this sets up for a classic problem that you and I have been through this. You and I went through this in meetings with clients, and you came out pretty dovish, Powell, last week,
right,
but not dovish enough. And the beast the beast in the market, that real dollar problem, what I call the global wrecking ball, is now strengthening, and you're starting to see some weakness, especially in emerging markets. Next slide.
I couldn't agree more. I mean, you can't transition, okay, from the economic performance of 2020 and the uncertainty and the lack of market confidence to 6% GDP real growth without the wrecking ball wrecking a lot of assumptions. And then you take, over $2 trillion of US stimulus and just pour it into it on top of it. And, we're going to have a phenomenal cauldron of side effects here.
And that's where your team, John Turek, has been fantastic. And this is, remember, before COVID, 70% of the budget, US budget, was interest and entitlements, 70%. And that was before COVID. So now we're heading up toward, real dangerous levels where, as you can see on this chart, the net interest as a percentage of the budget becomes greater and greater. And we're really in a different world here where the last 10 years, the Fed had a lot more wiggle room. Now you can make the argument that I was reading over the weekend of a famous portfolio manager, one of the PMs or one of these CIOs in our Bloomberg chat was telling us that 50 basis points, so 0.5% increase in U.S. interest rates today, because the debt is so much bigger today. You've got corporate debt so much bigger. You've got obviously U.S. debt so much higher, 10 trillion higher than it was a decade ago. And so 0.5% is now equivalent to most of the U.S. military's budget. And so it's a whole different ball game. And David, when you're talking to people around on the Hill about the CBO and their outlook, there's just, as I hear, just growing concern around, is the Fed going to have to cap rates? Because at some point, the interest costs just wipe out the entire budget.
I mean, we've got we're beginning to have, after 4 years of the Trump administration, where we sort of ignored budget numbers, Republicans gave up their traditional, fiscal hawkishness, and we cut taxes and enjoyed a boom, but it was for a lot of reasons. It wasn't just the tax cuts. Now you're seeing more. I mean, the stimulus checks are so large, okay, that even moderate Democrats are questioning whether we're in the right place. As this chart says it all, we have a tremendous national challenge coming up, and I want to just, I hate to say this, we don't have a team of people in Washington in the administration that are capital markets people. Okay, we are very much focused on the labor mandate at the Fed. That's the focus, and it's not on the other side of the balance sheet, which is how long is this sustainable? How long can you print? What's it mean?
Yeah, good point. Good point. Because if you're at 70% of the budget is interest and entitlements before COVID, where are we going to be a year and a half from now? So this whole thing is accelerating the yield curve control discussion. It's a totally different ballgame.
And this year is going to be a transformational year, as I said. I mean, we've never had China and the U.S. grow together at this rate. So that is going to just suck the commodity out from all over the world. Okay, and I think it's going to be highly inflationary at the same time.
Okay, we'll move to the next chart. We only have 4 charts, so it'll be real quick. So when are you coming in New York again? You back in New York this week?
I was there last week. Great to have clients back in their offices. Some are in, and some had to come down and meet me at the Starbucks. They don't let people in, but they are coming back
I
dined,
think of it.
dined in a
Meeting.
dined in a restaurant at 35% capacity. So
Okay.
it's nice to see New York coming back. I'll be back up this week. I'm going to be in New Orleans, Charlotte, seeing investors, and I'll be back up in the city the following week.
Excellent. Excellent. Well, you do more miles than I do a year. So God bless
Well,
you.
I mean, it used to be a lot more interesting because we have a great macro client base in London. They were always fun to visit.
So this is probably the most important chart of the day because we've been highlighting to clients, and with the help of ACG Analytics, and we couldn't have done this without you guys, but just looking at the legislation this year, looking at both the fiscal, monetary policy, we came up with the thesis through the spring and summer of 2020 around tech underperformance starting to develop in the later in the year as we have a larger budget, larger fiscal agenda, more regulation. But you can see here that this is the NASDAQ 100. So that's your big tech stocks versus Berkshire Hathaway. And we're looking at rolling 30 days of 14% outperformance by Berkshire. So this is very rare. But what happens throughout history is when you have one period of outperformance like this, typically it happens it's an indication of a major shift. And as you can see there, we had a bunch of them in 1999, 2000 on the left-hand side of the screen. We had some in 2007, 8. But right now, for the first time, you're seeing, like today, transports up close to 2%, FANG stocks down 2%. So that's a 4% outperformance by transports versus your NASDAQ. So clearly, this is a historic migration that's underway. And the question is, does it last?
Well, I think, Larry, I love this chart too, because, we all know that Warren Buffett never, struggled with tech stocks. He's so underweighted except for Apple, right? And so you're absolutely right. The economy, I believe we feasted on tech, and people are longing to go back to going out to dinner, re-engaging in the traditional economy. And, you're going to see, as I said, I mean, people go back to work, and they've even have money. Either the government gave them money and they have it in the bank, or they didn't spend a lot during COVID times, and they're going to come out, and you're going to see a lot of capital chasing a pool of goods. So we'll see. That's a great slide.
And this slide to me tells me exactly why you need to be talking to people like ACG Analytics. You need that mosaic research in Washington, because what's happening in Washington is a huge impact on the dollar. And because of, global debts and the amount of GDP that's outside the United States, you've got 64 trillion of GDP outside the US and 20 trillion inside. And, 20, 30 years ago, it was the US had a much bigger piece of the pie. Now you've got 64 trillion outside the United States in GDP, 20 trillion inside. So movements in the dollar, it's just amazing. We've had just a small counter trend rally, David, in the dollar, just a small blip. And look at this. You've got credit risk. This chart, you have to look carefully because the March period is skewing this chart. But if you look at Chile, India, Mexico, Vietnam, Brazil, these are pretty decent size upward moves in credit risk. And it really has to do with the dollar, the Fed not being, it's what's happening really is the beast in the market, that serpent in the market is going to keep pushing the Fed until the Fed breaks and gives the market a more dovish, even more dovish view. And there's a number of ways we can talk about that. I'd say people set up a call with ACG Analytics, we can have a chat. But the Fed really, if they don't pivot here again, the dollar keeps strengthening, and then the global recovery is at risk. And then remember, that feeds back to the United States very quickly. We saw this in 2013. We saw this in 2015. We saw this in 2018. We've had 3 bites at this really unattractive tasting apple. And you really need to watch credit risk now, sovereign CDS spreads, as it relates to the dollar and U.S. yields.
And we have a Fed call we're doing with John Turek on Wednesday. I do call, encourage people, if you like information about participating in that, to reach out, and we'll get you that information.
Okay. Well, great to catch up.
Larry,
And
we'd
I
love
think
to
we
see
covered.
you back in New York. As we said, the themes of the year are going to be, rapid GDP growth that we've never seen before, coupled with China's growth. Europe, obviously, perhaps in the end of the second quarter. I mean, you have to remember that the prediction from Washington is that everyone will be vaccinated by the end of May. Then we're going to vaccinate Canada and Mexico. Supposedly, the U.S. has enough of a supply to do Canada and Mexico. So you're going to see the integrated supply chains of North America really roaring back to life. And you'll see tourism hopefully back in Canada. We did a great call in Canada last week. We have a super team there. And so we used to have the arguments, are we decoupled from Europe? We may have some decoupling this year. I mean, because Europe, as we know, is still very much struggling with getting out from under the COVID pressure. And so we'll be there first and provide a lot of investment opportunities and landmines to avoid. So Larry, thank you. We miss you.
All right. Thanks very much.
In New York. Thank you for the opportunity.
You.
Okay, cheers.
Okay. See you at the top. Okay. Bye-bye.
Bye-bye.